The federal budget for 2026-27 has been officially released as a roadmap for national recovery. But for the people on the ground, the real question is whether these strategies will actually lower prices, help local businesses, or simply increase the burden of household taxes. To find out, we have to look past the political rhetoric and demystify the core numbers of the 2026-27 federal budget as presented to the National Assembly on June 12th. The government's central claim is that the country has reached an economic pivot. They point to a stabilized exchange rate and returning corporate growth as evidence that the economy is back on a path to recovery. This optimism is linked to external factors, specifically highlighting strategic foreign partnerships and regional diplomatic negotiations in Islamabad. The goal is to use international stability to buy the domestic economy room to grow. However, stable macro indicators don't always reflect a stable household. We have to determine if this recovery is a sign of long-term structural health or just a temporary improvement on a balance sheet. Grand macroeconomic stabilization carries little weight unless it translates into cheaper groceries, better jobs, and higher take-home pay for the average citizen. The engine for this recovery relies heavily on foreign corporate investment. The budget explicitly clears the way for international players, specifically looking to platforms and firms like Aramco, BYD, Turkish Petroleum, and the Alibaba Group to inject capital. Domestically, the strategy centers on the tech sector. The government is establishing 250 new technology zones, aiming to modernize the workforce and train a new class of tech professionals. To fund this modernization, the government allocated 26.3 billion rupees for digital learning, AI, and research networks. These ambitions are funded through shifting state assets, allocating 2,224 billion to manage the divestment of state-owned enterprises into private control. The government has set an aggressive timeline to finalize the sale of struggling assets, including PIA with its 185 billion framework, by 2025, supported by rigorous new compliance and enforcement measures from the FBR. By design, the government is shifting the responsibility for driving economic growth away from state institutions and onto the private sector and foreign investors. Then there is the energy sector, which continues to put strain on the federal budget, driven largely by global oil prices and existing contracts with independent power producers. To address this, the 2026 budget formally introduces the Competitive Trading Bilateral Contract Market, or CTBCM. This system is designed to introduce competition by allowing bulk consumers to buy power directly from generators rather than through a single state distributor. Concurrently, they are phasing out general financial relief in favor of targeted subsidies, including a $143 billion adjustment related to IPPs. This restricts government aid strictly to the most vulnerable demographics. While cutting these blanket subsidies and restructuring power contracts saves the government billions, it leaves middle-class households fully exposed to the price swings of the open energy market. On the street, these policies will be felt through three daily metrics: the cost of food, your utility bills, and the price of petrol. While the budget offers wide paths for foreign tech and industry, the direct tax burden required to keep the state running still lands on the wallet of the common taxpayer. The government plans to track its own progress using its official scorecard, the National Economic Transformation Plan, or the 5 E's framework. Hitting the targets in that plan requires long-term structural changes, like boosting exports and investing in human capital. These goals aren't achieved through tax collection alone. The 2026-27 budget establishes a clear macroeconomic direction for investors. Its ultimate success, however, will be judged by whether ordinary citizens can afford their monthly expenses.